What's up, everyone? I need you to stop what you're doing right now because something just went down in the silver market that most people won't understand until it's way too late. Over the last few weeks, nearly 100 million ounces of physical silver have been stood for delivery on the major futures exchange. Not just traded on paper, not rolled forward to next month, not shuffled around in some accounting trick. Delivered, physically taken, completely removed from the system. And when metal gets pulled out of the paper futures system at that kind of blistering speed, it's not just an ordinary trade anymore. It's sending a message loud and clear. So in this video, I'm breaking down exactly what happened behind the scenes. Why it matters way more than the daily price action you see. Who could actually be behind these massive deliveries? And what it might mean for small silver investors who don't have a seat at the institutional table. We're going to talk about the delivery numbers that are shocking the industry. The quiet policy moves happening that change the entire game. The tug of war between industrial demand and financial demand. And why the dollar's supposed strength might be the biggest optical illusion in modern finance. And once we connect all these dots together, I'm showing you the one critical pressure point that could force a repricing event mainstream headlines can't ignore. Because if you think this story ends with just a few large deliveries, wait until you see what happens when real-world buyers collide head-on with paper promises. A quick note before we dive deeper. My stats show a huge percentage of you watch these videos, but you're not subscribed to Market Pulse USA. If you value this kind of straight analysis, smash that subscribe button right now. Drop a comment saying Market Pulse USA to show you're supporting original creators and not the countless copycats stealing content. All right, let's jump straight in. Here's the first critical thing you need to understand clearly. Most casual observers think silver is just a price chart bouncing around. Up one day, down the next, maybe a little hype, maybe a little fear. But the real silver market isn't the chart you're staring at. The real market is the actual flow of physical ounces from the hands of sellers to the hands of buyers. In the exact moment the biggest buyers start aggressively demanding physical delivery instead of playing the paper game, the entire illusion gets seriously stressed. Because the future system only works smoothly as long as most contracts never actually end in delivery. They get rolled forward to next month. They get closed out early. They get netted and offset. That's totally normal market behavior. That's the engine keeping things running. But when sophisticated players show up and say firmly, "No thanks, I don't want your paper contract, I want the actual metal bars," it's like walking into a bank and demanding a mountain of cash while everyone else is still happily swiping plastic cards. And the numbers we're witnessing right now are absolutely not normal at all. One recent delivery month saw close to 70 million ounces stood for delivery. Then, in what's supposed to be a minor delivery month, the market still saw tens of millions more ounces within just days. That's the part that should make your eyebrows shoot up. Because minor months are supposed to be quiet and calm. They're supposed to be the months when the system catches its breath. Instead, it's acting like someone is actively pulling oxygen out of the room. Now, who is actually doing this aggressive buying? That's the question that turns this from interesting to absolutely explosive. Because retail stackers, even when they're highly motivated, don't show up and stand for delivery of 38 million ounces in a single week. That's not a couple guys buying tubes of silver eagles. That's not even a major coin dealer restocking their inventory. That's a scale that belongs to massive institutions, sovereign governments, mega industrial companies, or all of them working in parallel coordination. And when you seriously ask who would want that much physical silver right now and why, the list gets extremely short and uncomfortable. Maybe it's a government entity building strategic reserves. Maybe it's an industrial giant securing supply. Maybe it's a powerful consortium. Maybe it's someone who knows something critical about future supply constraints that the general public won't understand until the shelves are completely empty. And the even scarier possibility is that it's not one single buyer at all, but multiple independent buyers who are all reacting to the exact same set of alarming signals. Because in markets like this, what you often witness is not one player making a calculated move. You witness an absolute stampede of informed players all repositioning before the story becomes mainstream knowledge. And that brings us to the next critical part. The mainstream financial media is quietly whispering about market rebalancing and technical flows and normal volatility, as if this is just another ordinary season in the markets. But if you've watched this space long enough, you instantly recognize the familiar pattern. When real pressure builds dangerously under the surface, headlines get extremely loud about completely the wrong thing. They'll obsess over a chart pattern. They'll warn about speculative mania. They'll tell you to take profits before you lose it all. But they absolutely won't talk about the one metric that actually matters most. Who is physically removing the metal from the system? Because that conversation leads straight into an uncomfortable question nobody wants to answer. What happens if the exchange can't meet delivery demands at the pace these buyers are demanding? Now, I'm not sitting here saying the system collapses tomorrow morning. I'm saying the system becomes dangerously vulnerable when it's forced to do the one thing it was specifically designed to minimize, actually deliver physical metal. And to understand why this matters, we need to talk about rehypothecation. Rehypothecation is a fancy Wall Street word for a simple underlying problem. The exact same physical asset gets promised to multiple different parties simultaneously. Think of it like a parking space that gets rented out to 5 different drivers. Because the landlord assumes most of them won't show up at the same exact time. It works perfectly until suddenly it doesn't. In paper commodity markets, the same ounce can be represented by multiple layers of claims. Futures contracts, ETFs, backing shares, synthetic derivative products, complex swaps, options chains. It creates the comfortable appearance of endless abundance. It creates impressive trading volume. It creates deep liquidity pools. It generates substantial fees for brokers. And it creates an entire ecosystem where people trade silver exposure without ever actually touching physical silver. But the structural weakness of this system is painfully obvious to anyone paying attention. If too many people demand the real metal at once, all the paper promises get brutally exposed. That's why the best comparison isn't to a normal functioning market. It's to a classic redemption event. It's like an investment fund that promises daily liquidity while actually holding completely illiquid assets. It's perfectly fine while everyone remains calm. But when people suddenly rush to redeem, you find out what's actually real and what's just creative accounting. And that's why the analogy to famous financial frauds works so well. Everyone was happy while the dividend checks kept arriving on time, until they asked for their principal back. Then the whole elaborate thing had to reveal itself. The silver market has an identical vulnerability. It can manage paper flows smoothly. But physical flows are a completely different animal. So why now? Why is this happening right now? Here's where things get even more interesting. Because this delivery behavior isn't coming out of nowhere. It's happening alongside a series of policy and supply chain shifts that are quietly changing the landscape. For example, silver has been officially flagged as a critical strategic material, not because it's shiny and pretty, not because it's a collector's item, because it's absolutely essential for modern civilization, essential for electronics manufacturing, essential for solar panel production, essential for military defense systems, essential for the industrial backbone that modern nations literally can't function without. And once a material gets labeled critical, it stops being viewed as just a commodity and starts being treated as a strategic national input. That's a fundamentally different mindset. That's the mindset where governments start thinking in terms of stockpiles, domestic manufacturing needs, and long-term supply security. And while the public debates whether silver is too volatile to own, the big institutional players are asking a completely different question. Can we secure what we absolutely need before everyone else does? Now layer on top of that the reality that a massive share of global silver refining capacity sits in a very small number of hands. When the major refiners tighten export rules or prioritize domestic needs, the global supply everyone talks about becomes less global very quickly. And here's the part people really don't like to admit out loud. When a country controls refining of a huge portion of the world's silver, they don't need to ban you from buying it. They just need to slow down the faucet slightly. A small policy change can create a large downstream shortage. So when you see massive delivery demands on an exchange, at the exact same time policy signals are shifting toward prioritizing domestic needs, that's absolutely not random coincidence. That's a clear pattern. It suggests the big buyers are positioning for a future where available silver is not the same thing as silver that exists somewhere in the world. Because silver sitting in a vault in one country is not the same thing as silver that's accessible to global industry. Now let's talk about the scale, because people hear 100 million ounces and it feels abstract. Let's make it physical. A monster box of popular silver coins is heavy. Multiply that by thousands. Multiply that by tens of thousands. You're talking about serious logistics, security, warehousing, strategic planning. Nobody does that casually. And that's why the next question is the one we have to ask. Is a government involved? I'm not telling you it definitely is. I'm telling you the behavior matches exactly what you'd expect if a government was quietly building or replenishing a strategic stockpile. And before someone says, why would they do it in the open market? Remember, standing for delivery is completely legal. It's how the system is designed. If you have the capital and you want the metal, you can do it. And if you're a government agency or a connected institution, you might prefer to do it through mechanisms that look normal on paper, even if the scale is extraordinary. Now we also have to talk about industrial giants, because the industrial side of silver demand is not a theory. It's not a maybe. It's a real pipeline of usage that keeps expanding. When a company that depends on silver for manufacturing begins securing supply directly from producers, it's not because they want to speculate, it's because they genuinely fear supply disruption. And we've already seen the blueprint for how that works. Instead of buying on the open market and hoping the supply is there, major buyers go directly to producers. Buy doré or concentrate and lock it down. They pay up, they secure the feedstock. They send it to their own refining channels. They remove middleman risk. That is absolutely not the behavior of a market that thinks silver will be plentiful forever. It is the behavior of a market that thinks the next shortage could be a national problem. Now here's where it gets spicy. When industrial buyers start to panic, they don't buy a little more. They front load aggressively. They stockpile. They say, if I need this for the next 5 years and I'm not sure it will be there, I'd rather hold too much than too little. Because running out of silver isn't like running out of paper clips. It can shut down entire production lines. It can halt critical contracts. It can become a reputational disaster. And this is how the battle sets up. On one side, you have industrial demand that is absolutely non-negotiable. They need silver to operate. On another side, you have investors who see silver repricing and want exposure. On another side, you have governments who see silver as strategic and want supply security. And then finally, you have retail investors who show up dead last, paying the highest premiums, fighting for scraps. That's not me being dramatic. That's how commodity cycles usually work. The easy supply gets spoken for before the public understands what's happening. And if you want one of the simplest signals that silver is not a normal commodity, it's this. A surprisingly small portion of mined silver comes from primary silver miners. A huge share comes as a byproduct of mining other metals. That matters enormously, because byproduct supply doesn't respond quickly to higher silver prices. If silver doubles, copper miners don't instantly double copper production just to get more byproduct silver. The supply curve is rigid, so when demand rises and supply is rigid, the pressure doesn't release gently. It builds, and then it snaps violently into a new price regime. Now, speaking of price regimes, let's address the elephant in the room. Silver has moved fast. And whenever silver moves fast, people get scared. They start saying, this is a blow-off top. This is a bubble. This can't last. But here's the difference between a bubble and a repricing event. A bubble is driven by pure speculation and collapses when belief collapses. A repricing event happens when the underlying reality changes, and the old price no longer matches the new scarcity or demand structure, when you have consistent structural deficits, and you have buyers removing physical supply, and you have policy moves tightening access. That's not a bubble narrative, that's a scarcity narrative. And scarcity narratives have a habit of becoming very real very fast. One of the biggest mistakes small investors make is they focus on price action and completely ignore ownership behavior. Price is the public scoreboard. Ownership is the private strategy. And right now, ownership behavior is screaming. Because if the biggest money in the world is moving billions into physical acquisition month after month, you have to ask yourself, what do they know that you don't? They might know about future demand. They might know about future supply disruptions. They might know about policy changes. They might know about refining bottlenecks. They might know about hidden short exposure that can't be managed if delivery pressure continues. They might know that the paper-silver market is far more fragile than people assume. Or they might simply know that in a world where currencies lose purchasing power, hard assets are the lifeboats. And that takes us to the part of this story that connects silver to everything else, the dollar. People love to say the dollar is strong because of the dollar index. But that's like saying a person is healthy because they're taller than the sickest people in the room. The dollar index measures the dollar against other fiat currencies that are also being devalued. It's not a true yardstick of purchasing power. A better measurement is what can your dollars buy. And when you measure dollars against gold and silver, the story is different. Because what has happened over the last couple decades is that assets priced in dollars look like they're going up, but assets priced in gold often look like they're coming down. That sounds crazy until you do the math. Let's use a simple example. 20 years ago, the average house price in the US was in the low 200s. Gold was in the mid 400s. In that world, it took a little over 500 ounces of gold to buy an average house. Fast forward to today. And yes, house prices are much higher in dollar terms, but gold is also dramatically higher. And when you compute the purchasing power, those same ounces of gold can buy multiple houses today, not one, which means the house price didn't go up as much as the currency fell. This is the part most people struggle to accept. The currency is the thing that is changing. The unit of account is the thing that is melting. So when you hear silver is going up, a smarter framing is often the dollar is going down. And silver is showing you the truth. And that matters because if the system is built on perpetual currency dilution, then hard assets don't need to win. They just need to remain hard while the money remains soft. Now I can already hear someone saying, okay, but what does that mean for me? Here's what it means. If you're a small silver investor, you can't outbid governments, you can't outmuscle industrial giants, you can't outleverage hedge funds, but you can pay attention early. You can understand the difference between paper narratives and physical signals. You can stop letting mainstream headlines scare you out of positions at the exact moments when physical accumulation is accelerating. You can think like a risk manager, not like a gambler, and you can avoid the trap that kills most people, waiting for confirmation from the same outlets that ignored the signals. Because once the mainstream starts screaming about silver, it won't be because it's safe. It will be because it's obvious. And when it becomes obvious, it becomes expensive. Now let me keep this practical. So let's talk about the mechanics of why deliveries matter so much. When a lot of contracts stand for delivery, it forces the exchange's inventory system to perform under pressure. It forces movement between registered and eligible categories. It forces allocation. It forces bars to be located, transferred, verified. And none of that is impossible. But at scale, it becomes sensitive. Because the moment any part of that chain slows, rumors spread. And when rumors spread in a commodity market, people don't wait for the official press release, they act. That's why physical delivery pressure can be self-reinforcing. More deliveries lead to more attention. More attention leads to more deliveries. And at some point, the paper market can't suppress the signal with headlines. Now I want to be clear. The goal here is not fear. The goal is awareness. Silver is not a get-rich-quick ticket. Silver is a strategic asset that sits at the intersection of money, industry, and security. That plurality is rare. Most commodities are industrial only. Some assets are monetary only. Silver is both. Plus, it has military applications that never show up in polite conversations. So when you see a multi-year structural deficit, and you see acceleration in delivery, and you see policy shifts, you don't need to panic. You need to pay attention. Because this is exactly how long-term repricing stories begin, quietly and then suddenly. If you found this useful, subscribe to Market Pulse USA right now. Drop Market Pulse USA in the comments if you want me to keep covering delivery data and behind-the-scenes signals. And remember, the biggest moves don't announce themselves with fireworks. They announce themselves with shortages, then with excuses, then with policy. And by the time the headlines catch up, the doors are already closing. This is Market Pulse USA. Stay sharp, stay informed, and I'll see you in the next one.